Hey everybody, this is Greg Gossett, and today is Sunday, July 31st, 2022, last day of July. Appreciate you coming and spending time here for the Gossett Trading and Mentoring Weekend Review. And the format of today, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at my current positions. We're going to talk about when I bought them, why I bought them, and how I am going to manage them going forward. I have 2 trades on the daily, 1 trade on the weekly that we will cover. After that, we're going to talk a little bit about trader psychology, most important skill in trading, without a doubt, in my humble opinion. But it is very important. It is a skill. Creating a plan, following your plan, and getting the emotions out of it so that you actually do follow your plan. And I'll touch on that a little bit more. But I have something good to cover on that. Hope that's going to be helpful. After that, as always, I do like to cover a trading pump by my friend Frank, and always fun to see those, and always relevant and pertinent to what's going on currently in the market. After that, I have gone down through my watch list. These are trades that I will be looking for next week. Have some short trades, potential short trades in there. Haven't had a lot of short trades lately, but this one, this week with the rally that we've had, I do have some potential short trades. So that's what I'm looking for next week. Some potential longs, some potential shorts, but we'll go through and I'll discuss what I'm looking at and why I'm interested in them. All right, I think that's the plan. That's what we're going to do. I do have to run the U.S. legal disclaimer. I'll be back in about 40 seconds. Hang tight. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All righty, thanks for holding through that with me. All right, let's get started. First trade was Pfizer. I did buy Pfizer all the way back here on the, let's see, what is this? The 17th of June. This has turned out to be a really good trade. For those of you that listen to the podcast, I do like to look for confluences, combinations of indicators lining up. And this is exactly what this trade was about. Entered based upon 2 criteria or 2 signals. The first was we went under 30, over 30. Of course, that's an valid entry signal for me, but it also came at the same time where we had an intraday rejection of the 300-day moving average. So bought here at 46.53. You can see it has moved up beautifully. I always take partial profits regardless of the long trade or the short trade that I have. And so whenever this moves up the value of 0.45 ATRs, right now it's 0.55, but I always take partial profits off. I like to play offense and defense with my trading. And, first of all, most important thing always is your emergency stop. And I'll get into that on some other trades that I have, but placing your emergency stop, most important. End of day stop, also very important. What would have been my end of day stop? Well, I took this trade essentially based upon the under 30, over 30, and the under over the 300. So if it had just closed below the 300-day moving average, I would have gotten out. But so I always place the emergency stop. And like I said, I'll go through this in detail on a different one, not on Pfizer here because I'm out of it. So place the emergency stop, place the end of day stop. It's all about risk to reward. Once it gets 1.5 ATRs from my entry, I go into trailing stop mode. Once I go into trailing stop mode, if I get it closed below the previous day's low, I get out of half. And so I got out here 50.65 with the close underneath the previous day's low after reaching the trailing stop level. Continue to move up. continue to take partial profits on the way up. Like I said, it's very important to me to play offense and defense in your trading. Defense is considered your emergency stop, your end-of-day stop. Offense, to me, is considered taking partial profits on the way up. Emergency or trailing stop, that would be considered to me a defensive maneuver. So got out of half here, 50.65, moved up, continued to take profits. My end-of-day stop was a close below the 300-day moving average, so that was way down there. And I don't hold through earnings, so earnings were here on the 28th. I got out at the close on the 27th at 51.55 for the last portion that I had remaining, a gain of 9.72%. The first move was lower than that, but as it moved up, continued to take profits. So anyway, nice little trade. Great risk to reward, and that's really what trading is about. If I'd have been wrong, yeah, it could have gone down and just broke from here as well, but I would have had my emergency stop down there. So that's accounted for and taken care of. But anyway, really good trade on Pfizer, and I am out of Pfizer, and it was good that I got out before earnings. As you can see, I got out at 51.55. It's 50.51 right now. All right, let's go to the next trade. Rio. I did buy Rio back on, looks like this, back on 7/15, is that right? Yeah, 7/15. So July 15th, why did I buy this? Well, I bought this with an under 30, over 30 here at 55.33. Also a bullish engulfing bar to the upside. In the Pfizer analogy, I had already taken off my emergency stops and my end-of-day stops. But so first of all, whenever I look to enter a new trade, the first thing you have to do is you have to account for the volatility, and you have to account for how many shares of something you are going to buy, right? So what I do is I take my maximum allowed loss on any one trade. And how I come up with that, a good rule of thumb is 1% of your trading capital. So if you have a $50,000 trading account, 1% of that is $500. That's the maximum I want to lose on a trade. And so what I do is I take my maximum allowed loss, in this case $500, I divide it by the value of the 2 ATR. That tells me exactly how many shares to buy. If, let's do the math here. So right now, let's just use this number. So if I'm $500 is my maximum loss, divided by the value of the 2 ATR, divided by 3.85, would tell me to buy 129.87 shares. So essentially 130 shares. If 130 shares moves 3.85 points, how much is that? It's $500. And so that's what's so nice and handy about using the 2 ATR. You're taking into account the volatility. If there's more volatility, it's going to have you buy fewer shares. If there's less volatility, it's going to have you buy more shares. So I place my emergency stop exactly whatever the value of the 2 ATR is below my entry. If it gets there, then I've lost my $500. Or if I'm trading $100,000, 1% of that's $1,000. You see what I mean? So don't say, oh, it's $500, right? It depends on what. If you have a $25,000 account, then 1% of that is $250. So that's my emergency stop. That is the defensive move. Now, end of day stop. Well, why did I take the trade? I took the trade because it went under 30, over 30. So if it were to have closed below the 30 RSI, I would just get out. Only about 5% of the time are you going to hit your emergency stop. So that $500 maximum loss we were talking about, majority of time on that trade, you're not going to hit that. If you have a loss, it will be much smaller. But luckily on this particular trade, that did not come into play. And so bought here 53.33, placed my 2 ATR emergency stop below. My end of day stop is a close below the 30 RSI. Orange line here is the 1.5 ATR trailing stop level. And here's the value of the 1.5 up here. So I take my entry, whatever the 1.5 is, I add it onto it. Once I get there, I get into trailing stop mode. Well, here's the orange line. And what was this? Back on the 25th, it did reach it. Or no, I'm sorry, on the 22nd, it did reach it. Now I'm just looking for a close below the previous day's low to get out of the trade. Well, here it closed above the previous day's low. Here it closed above the previous day's low, and it's just continued to move up. So I am in trailing stop mode, but I have not had a close below the previous day's low. Also, I am taking profits every time this moves up, and I've been taking profits on this entire trade. So again, offense and defense is very important. This particular trade on the shares that I have remaining, up about 9.36%. And if Monday, tomorrow, we had a close below the previous day's low, I would just go ahead and get out of half. If it continues to move up, I'll just continue to take partial profits on the way up. And I mention this each podcast. Sorry, my voice is I've been a little sick this weekend, everyone. Apologize. So I sound a little rough and feel a little rough, actually. Now I lost my train of thought. Oh well. We'll just keep going with it. But as long as this keeps moving up, I'm going to continue to take partial profits. If I get a close below the previous day's low, I will get out of half. But this has been a really, really nice trade, up 9.36%. Okay. So Pfizer and Rio were both on the daily time frames. As you know, I like to trade multiple time frames. I think it helps to smooth out your equity curve. I like to trade weekly time frames. I like to trade daily time frames. And this is DDM on the weekly. Now, weekly trades I take on Friday because the bar closes on Friday. I did buy DDM back here on the weekly on the Friday, 7:15. We closed under the 200, over the 200, bounced, closed above, bounced, closed above, bounced, closed above. That's pretty good. It's pretty good. What's the word I'm looking for here today? Well, can't find the word. I must be a little sicker than I thought. But anyway, I did buy here at 58.25. Now, when I bought, I have to place my emergency stop. And again, just taking my maximum allowed loss, dividing by the value of the 2 ATR up here, 1075. That shows how many shares to buy. And then it also shows how far below my entry do I want to put my emergency stop. And now my end of week stop would have just been a close below the 200-day moving average. Well, luckily this trade has gone up nicely. You can see my orange line up here. That's my 1.5 ATR trailing stop level. So it's not to trailing stop level yet. Once it gets there, if I get a close below a previous bar, I will get out of half. Of course, I am taking profits on the way up. And this particular trade's been a good one. It doesn't look too impressive, but percentage-wise, this one's pretty good, up 9.3%. Oh, I know what I was going to say. So, I've mentioned this before, but in this podcast, I kind of go through with the time constraint that I have to show you what I'm doing. I do teach private one-on-one lessons in the evening time via Skype. I teach you all 5 of the different trading approaches, and I teach you every single step by step. So I'll talk a little bit about that at the end of the podcast. So, if you really want to learn how to trade like this, I'm available for you to do that. And I think it's worth your time and your energy and your money to do that. So anyway, I'll talk about it a little bit at the end of the day. End of the podcast. But anyway, so up 9.3% on the remaining shares that I have. Once it gets to 1.5 ATR trailing stop level, then I will go into trailing stop mode, get out of half if I get a close below the previous day's low. All right, so those are the 3 positions that I had. Wish I had more. Obviously, we've had a nice rally. I hope a bunch of you have had some nice profits on your longs. It seems like the market has moved up. If you remember a month ago or when everything was down, I was like, don't worry, it's going to turn around. It did turn around. Really glad for that. And I hope you've been on board for some of that as well. So just to recap, Pfizer. Out of Pfizer was a nice trade, remaining 9.72%. Rio, also a really nice trade. Have not had to, I've been getting out, scaling out on the way up, but no defensive measures to the downside. But if I had a close below any previous low, I'd get out of half. And then DDM, which is double leveraged Dow, up 9.3%. So, all right, let's talk a little bit about trader psychology. Very, very important, everyone. I've been trading for 27 years, and I'll tell you what, whenever I get in trouble, it's when I don't follow my rules. And that comes down to trader psychology. So this is from the Divergent Trader at Trader Divergent over on Twitter. It's a great channel. I mention and go over his posts quite a bit because they're great. They're succinct and they're wonderful. It's wonderful advice. So the best traders are 100% patient. Don't force trades. Be patient. Wait for your edge. It's so true, everyone. Patience is paramount in trading. It really, really is. Waiting for those confluences, those combination of indicators to line up. It doesn't mean you're going to be right, but it means that it gives you a good risk to reward. And that's really what profitable trading is about, is letting your winners run, giving them room to breathe, scaling out like I do, taking profits on strength, having your emergency stop, having your end of day stop. If you're wrong, right, but giving it some room to breathe in case you're right, whether it's to the long side or the upside. So the best traders are 100% patient. Are you 100% patient? I wish I was all the time, to be honest with you, but I'm not. I'm just being honest. It's something I have to work on as well. That's why I picked this to talk about today. But don't force trades. Be patient. Wait for your edge. If you could just sit back, not trade, just wait for a really good confluence combination of indicators lining up to the short side or the long side, it's going to improve your trading. So please follow at Trader Divergent over on Twitter, and because I really think it's a great channel over there. All right. Before we start looking at potential the potential trades for me next week to the long side or the short side, always like to talk a little, or I'd like to go over Frank's poem. Frank is a friend of mine, great poet, great trader, great author, great musician, and please follow him at FrancoD over on Twitter. Everything suddenly is coming up roses. Bad news rejected as they turn up their noses. Buy some stock before the market closes. There is no recession in their data discloses. Well, I think some people would argue that last point, but it's a great poem regardless. Everything suddenly is coming up roses. Right. The market's going up. Bad news rejected as they turn up their noses. We have had a lot of bad news and the market's still going up. So that may be telling us something. Buy some stock before the market closes. There is no recession in their data discloses. And what I was talking about before, I think we've had 2 quarters of negative GDP, which would justify calling it a recession, but I believe they changed the definition of that. So I'm not going to get into that, but I think the takeaway here is follow the technicals, follow the price action. That's really the truth, not what you read on the news, and not what people are telling you. Follow what the price is. That's the real truth. Thank you, Frank. Appreciate that, bud. Okay. Hey, I'm just going to circle back to talking about the multiple time frames. I really like trading multiple time frames because a lot of times maybe one time frame is not working for you, but another may be. For the last 3 years, and I've mentioned this before, but I do day trade all day long. And over the last 3 years, I have not had a losing month in day trading in 3 months. 3 years, excuse me, which is pretty dang good. Well, July, I did have a losing month in day trading, a pretty good loss. Actually, not good. It was bad. But thankfully, my swing trades helped mitigate a little bit of that. Whereas a couple months ago, when I was having record day trading months, my swing trades were not doing well. I don't think anyone's swing trades were doing well because the market was heading down. So I think it's a good real world example of showing that, yes, last month, after a great string of 3 years, not one losing month, I had a significant down month with day trading. But the swing trades from the dailies and the weeklies that I just showed you help mitigate. So I thought it was a good teaching example that you could probably relate to in real time. So, all right, let's take a look at some potential trades for me for next week. The market's rallied significantly. So there are not a lot of juicy deep dip buy kind of trades because we've moved up so much. So you're going to see me talk a little bit about the short side tonight as well. But let's start out with Intel. So Intel did not have a good earnings report. You can see we were at 39.68 and at one point we got to 35.24. So good example of why I don't hold through earnings. Last week we had Amazon, Apple, everything was up, but it can certainly go the other way as well. So the reason what I'm looking at on Intel right here is we do have double bottom bullish divergence. Here's a bottom with deep red MACD bar. We rallied strongly and now we've come back. We are at these particular lows, but you see how we don't have any red here? That means that the selling pressure on this first move down was very significant from a MACD perspective. This move down here is significant on the chart, but from a MACD perspective, the momentum's not even strong enough to get us into red. So this is what's called a double bottom and a bullish divergence. Now, just because you have a double bottom and a bullish divergence doesn't mean you can just jump on in. You need some kind of trigger to trigger you into the trade. I don't feel like we're there yet. I mean, we did undercut the previous low back on the 5th of July, which is good, but there's a huge, massive gap here. I'm kind of leaning towards it's going to be very difficult to just erase this and go back up. So what I'd like to see this do is move sideways for a week, something like that, and then look for a V1 or a V2 entry to trigger me into the trade. With the V1 or V2 entry, then I know exactly where my stops are. They're great. It's kind of the bread and butter of my trading. And so what I'm looking for, don't know if it's going to happen next week, just looking for some sideways motion, then one break to the downside that's immediately reversed back up, giving me a good risk reward ratio with the V1 or a V2. So that's what I'm looking for on Intel, sideways motion, or possibly an under 30, over 30 as well. We're here at the negative third ATR channel. It bounced right there. 92% of prices do that. So anyway, kind of slim pickings to the long side right now. I mean, the market could continue to go up. We have momentum. I have some positions there to the long side, but I'm going to be patient. I was just talking about being patient, right? In the trader psychology section. So I don't think Intel is just going to be able to reverse and go back up. This was a big move down for a reason, but sideways motion, V1, V2 could get me into the trade, or an under 30, over 30, especially being that we have a double bottom with the bullish divergence. So that's what I'm looking for next week on Intel. Meta. Well, Meta has not participated in this rally like the rest of everything else. But look, we do have a lows here that are being respected. Right about 155 level. We went to 155, we went up, came back down, bounced to that level, went way up, came back down, bounced to that level. It was down on Friday, but here again, we have a double bottom with the bullish divergence. Here we have a big move down with deep red MACD bars here. We've rallied into green, we've come back down, we've tested these lows. There is red, but not as deep as red as over here. That's showing that the selling momentum is waning. So again, just because we have a double bottom bullish divergence doesn't really mean anything. It's a good sign for potential rally, but we still need a trigger. And what I would be looking for on Meta would be an undercut of these lows here, and then a V1 or a V2, possibly if it goes lower, an under 30, over 30. But just looking for some kind of entry, V1, V2, under 30, over 30, possible ICT entry, because this is a level of liquidity that we've run. If we can run it to the downside, then then go up, take out a previous high, that would change the market structure to the upside, and then wait for a pullback. Now, I've been talking about ICT stuff a lot, and I have no affiliation with this channel, but it's a great channel. I've learned a lot. My trading partner Ava has taught me, but check out the Inner Circle Trader, or ICT, over on Twitter. He has tons of videos. They're really outstanding. I would suggest watching number 3, 6, and 9 if you're interested in these fair value gap trades. And that's what I'm talking about here. This is the level of liquidity. I would not be surprised if we ran it to the downside, but then came back up, took out the first swing high. That would turn us into a bullish market structure. Then I'd have to just wait for a pullback into a value gap. I'm not an expert with these. That's why I'm suggesting watching the ICT videos number 3, 6, and 9. But that's what I'm looking for. There is definitely a level of liquidity here. There's multiple points. There's one here, here, and here, and we've bounced off that level. Wouldn't be surprised to see this move down and then a big move up to change the structure and then wait for a pullback. You know the old saying, buy dips in an uptrend, sell rips in a downtrend. That's essentially what the ICT strategy is all about. So again, just to summarize, on Meta, looking for an under 30, over 30, some kind of false breakdown of these lows here and reverse back up with the V1, V2, or a run on liquidity, come back up, take out the previous swing high. That would turn us into a bullish market structure, wait for a pullback. Philip Morris. Well, Philip Morris is kind of interesting, because you see this big bar we have down here, or this big bar. This is a big, strong down bar on lots of volume. There was lots of selling, and you can see that the selling volume, or the selling pressure, continued here. Usually, if you have a big down bar like this and you rally back up, you're going to get stuck at about halfway of the bar. Well, look, that's exactly, see the big down bar over here? You can see Philip Morris has tried this 3 days in a row to get above this, get significantly above this 50% move of this big down bar. Hasn't happened. So being that we've kind of got rejected, or at least stalling at this halfway, makes me believe that we're probably heading down. So if we do, my trigger on this trade would be a close below the 200-day moving average. That's the black line here. If we can close below there, I will probably get short. Of course, I'll have to place my emergency stop above. At this point, 441, my end of day stop would be a close above the 200-day moving average. If it moves down my direction, well, then I can take profits to the downside, like I always do. So I am looking for a short if we get a close under the 200-day moving average. All right, here we go. SPY. Well, I am looking at a potential short on SPY. Back to ICT, we do have a level of liquidity over here, multiple points that got ran. We broke the market structure to the downside. We have these gaps here. If you remember, I don't know, a month or two ago, I was talking about these gaps when we were down here would probably get filled to the upside, and they did. Here, filled this gap. Here, we filled this gap. But this swing high up here is going to be a significant swing high level. To get above that. If it does, we may continue higher. But what I'm looking at on the SPY here is, here's the value gap in between this bar and this bar. The low of this bar, the high of this bar, the two purple lines, this is the value gap. This is probably where it should fail. It did close above the value gap. That's why I did not get short. But had it rejected the top of the value gap, I would have got short on Friday, but it did not. It closed above. So if we close back underneath the value gap here of 411, that will be my signal to get short on the trade. It will, if that happens, we will have also rejected the 100-day moving average to the upside. My stop would just simply be any close above this high here. So I'm just waiting for Monday. If we close below this top line of 411, that would be my signal to get short. I would place my emergency stop as always. My end of day stop would just be a close above this consolidation of this pivot right here. Twitter, another potential short candidate. And anybody guess why? Well, we're getting close to the third ATR channel. We're getting close to the 200-day moving average, which is downward sloping. If we go up this week, reject the 200, either close above, then close below, that would get me short. If we had an intraday rejection where we went above it during the day and close back below it during the day, that would also get me short. I like to trade on multiple time frames. I like to look at multiple time frames and look at the weekly. We have the weekly, the 200-day moving average right here at 42.61, so about $1 above. That's probably going to act as resistance above on the weekly. So I like the confluence of a rejection of the 200-day on the weekly and also on the daily. They're going to be right at about the same place. So that's what I'm looking for on Twitter, some kind of rejection of the 200-day moving average. I want to go back to SPY real quick. Interesting on SPY, we had such a big day on Friday, but look at the volume. There was hardly any volume here. I honestly did not notice that. There was big move volume on the move up. This day here continued with a higher move, but this was a significant move up on very low volume. That makes me a little concerned about the viability of the rally. It could certainly keep going. There's no doubt about it. You never know, but this is something that I noticed. Verizon. Well, here we go. We had a lot of nice sideways motion. Boy, did we break down hard. Now, there's some value gaps to fill here, which would be interesting for me to get short on Twitter. And the main value gap that I'm interested in is between the low of this bar here and the high of this bar here. The way that I trade these value gaps, if for some reason, I mean, we could just fail here and go back down, but if we continue to get back up into this value gap, the higher the better, because as you get higher here, you know, my stop here would be this swing high, and we also have the 200-day above. So I really like this trade, but if we start getting into the value zone, or I'm sorry, into the value gap, I like to scale into these trades. I would add a little short here, a little short here, a little short here, a little short here. I wouldn't add above, just like I just mentioned on the S&P. But I think it's very unlikely that Verizon is just going to continue back up. I could be wrong. I'm wrong all the time, everyone. But this is such a dramatic down move that, yes, a dead cat bounce here makes sense, but I'm going to wait somewhere between 50.18 and 47.95, and I will add slightly as it moves into this fair value gap here. But if it does close above that swing high, then I will have to go ahead and take my stop. But of course, as always, I'm going to have my emergency stop, my end of day stop. My end of day stop is just the swing, a close above this swing high here, and I will slowly add shorts. I won't take the whole position right at once. I mean, it might just go here and then right back down, and I wish I would have taken the full position, but I may add here and it may continue up. So I like to phase in to the shorts right here. All right. And then healthcare here. Yeah, this one was a mistake. I should not have had it. I should not have had that in there. That was I think from last week. So anyway, Intel, just recap, looking for some under 30, over 30, or some kind of breakdown from this low with a V1 or a V2. Meta, the same as Intel. We have these lows here, multiple lows here. Wouldn't surprise me to see it break it to the downside. Like to see it break down to the downside, reverse back up with the V1 or V2 to get long, or an under 30 over 30. Philip Morris, looking to get short with the close under the 200-day moving average. SPY, closed above the fair value gap. If it closes back in, that will be my signal to get short. Twitter, some rejection of the 200-day moving average. Would also get me short. And Verizon, same short. So really looking at the short side right now. So at the beginning of the podcast, I talked a little bit about the private course that I do, the one-on-one. You know, I think it's to learn anything, I think it's best to do one-on-one with your instructor or your teacher and your mentor. And that's why I provide this format. I teach 15 complete hours in my course, the one-on-one, 5 sessions. Each session is 3 hours, usually do once a week. It's a great course. I've taught so many people from around the world. Gotten so many good reviews and feedback. You know, I talked to a couple of my students over the weekend. My gosh, did they do well last week. Really, really proud of them. But if you're interested, if you'd like to take your trading to a higher level, I can help you do that. I promise you, I've been trading 27 years and been through a lot of different markets, and I think I teach a really good course. So if you're interested, my email is in the link of this YouTube video. Just send me an email. Say, Greg, I'm potentially interested in your course. I'll reply and say, great. Look, let's set up a Skype call. The Skype call is free. It's not a sales call. I just want to learn more about you and your trading, what you're hoping to achieve. It's a good time for you to ask me any questions about the course. And after that, I will not contact you. You need to contact me back if you want to take the course. But the course is $1,750, but the one-on-one attention you get, the content that you receive, it's worth every penny. So if you are interested, please reach out to me and we'll schedule a Skype call. Okay. Number two, I do have a great online course available on udemy.com. It's called the Deep Dip Buy Stock Trading Strategy. It's a wonderful strategy. And a lot of these lows that we hit recently have been from that. The course is only $12 or $15, but don't let that low price fool you. There's a lot of content there. There's 9.5 hours of video. There's 26 videos total. There's 15 study guides. So if you're interested in that, it's a great place to start. Super, super affordable. I've gotten so many good reviews from around the world on that course. And if you're interested, the link is in the description. And then lastly, if you like tonight's podcast, I would appreciate it if you could hit the thumbs up button, or if you liked any of the podcasts in the past, I would appreciate that. Let's YouTube know that there's some valuable content here so they can get out and share it with people. And so that's all I ask. So I hope you have a really good upcoming week. As always, I hope you could try to go out and do one nice thing for another human being today. I hope and wish if possible, that you could go out and do one nice thing for an animal today. Humans, animals, they like random acts of kindness, and it really would make the world a better place. And hopefully one day, if you have a bad day, you're going through something, someone will be there for you as well. So that's all I ask. Hope you have a good evening. Hope you have a good trading week next week. We'll see if this momentum keeps going forward. But those are the trades that I have. That's how I'm managing them. And the Intel, the Meta, the Philip Morris, the SPY, the Twitter, and the Verizon are what I'm looking at for next week, as long as they do what I just went over and what they need to do. So I think that's it. Appreciate you being here. Appreciate you spending your time. Have a great upcoming week. And on the way out here, I have to run the U.S. legal disclaimer. Thanks a lot, everybody. We'll talk to you next week. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.